Union Budget 2023-2024 to be tabled on 1st February 2023 would be the most challenging one for the Finance Minister Nirmala Sitharaman. The upcoming budget would not only have to lay the roadmap for India's growth momentum at a time when the whole world is staring at recession, but it is also crucial because it would be centre's last full year budget before the upcoming election in the year 2024. Therefore, from corporate to common man, everyone is looking towards the budget expecting reliefs and reforms that would benefit them. However, in the past, there had hardly been any tax relief that would benefit them. Mostly the middle class, the segment that drives the major consumption in India. So in this video, I would be covering 6 important expectations of a common salaried person from this budget. The first expectation is to increase the deduction limit under Section 80C. The Section 80C limit was last increased in the year 2014-2015 from 1 lakh to 1.5 lakh. Since then, the deduction under Section 80C, which encourages the maximum tax-saving investment, remained unchanged. There is a long-standing discussion to increase this limit from 1.5 lakh to at least 2.5 lakh. Currently, 80C allows deduction for investment made in PPF, EPF, LIC premium, ELSS, principal payment towards home loan, stamp duty, or it could be registration charges for purchase of property, Sukanya Samriddhi Yojana, any NAC certificate, or if you have taken any tax saving FD for 5 years. But in the current inflationary time, if you have a home loan and a child's fee, the principal from the home loan and child's fee will only exhaust the complete 1.5 lakh rupees deduction. Therefore, the government has to really think on this particular area and increase the deduction from 1.5 lakh to 2.5 lakh. It would help the middle class to invest at least some money in tax saving instruments. The second expectation is to change the income tax slab rate structure. The tax rate have not been considered for revision since 2017 and 2018. However, there was a new tax regime introduced, but that was not adopted by majority of the taxpayers because of its unviability as compared to the old tax regime. According to Deloitte, an accounting and auditing company for tax purpose suggested revision in tax slab rates in budget 2023. According to them, for the people who earn more than 20 lakh rupees, the tax rate should reduce from 30% currently to 25%. And for the people who fall in the income bracket of 10 to 20 lakh rupees, the tax should be reduced from 30% to 20%. When it comes to the new tax regime, the tax slab for income in the range 10 to 20 lakh bracket should be reduced from 30% to 20%. And for the income bracket of 20 lakh rupees, the tax rate under the new tax regime should be reduced from 30% to 25%. The third demand is to increase the deduction limit under Section 80D. Every individual in India should have optimal health insurance coverage. However, from last 2 years, the insurance premium has increased drastically, specifically after COVID-19 pandemic. Taking this into consideration, increasing the Section 80D limit from 25,000 for non-senior citizen and 50,000 for senior citizen is a justified demand and should be always fulfilled. So the fourth demand is to raise deduction limit for interest payment on home loan. So according to people, government should raise the deduction limit for interest payment on home loan from existing 2 lakh rupees to 7 lakh rupees. Some home buyers say that due to repeated increase in the interest rate, it has started to hurt their repayment capacity. Either their monthly EMI is shooting up or their loan tenure is increasing. Moreover, after COVID-19, the property price has skyrocketed. A simple 2 BHK in a good location would cost you around 50 to 60 lakh rupees nowadays. On top of that, if you get into EMI, the interest part only would eat up the complete repayment process. So it is very important that the government should enhance the tax rebate on housing loan interest from 2 lakh rupees to at least 7 lakh rupees. So the fifth expectation is to make NPS annuity completely tax-free. Right now, under NPS, if someone attains 60 years of age, 60% of the money is tax-free. However, 40% of the money which is taken as annuity is taxable and which will be taxed as per the income tax applicable. So the people want that this part also to be tax free. So the last expectation is to simplify the capital gain tax regime. Previously, before every budget, there used to be a noise to change the capital gain tax regime. This year too, this is happening, and the center is seriously looking to change something and make it simpler. If you see the capital gain tax rate, it is quite complex for different asset classes, and moreover the holding period is also different. For equity and equity mutual fund, in short term flat 15% is applicable. However, in long term it is 10% without indexation. Here one thing is good, that if you hold it for long term and your profit is more than 1 lakh rupees, and when you want to sell it for that 1 lakh rupees, it will be exempted, and the rest of the amount 10% tax will be applicable. For non-equity MF, which is a debt fund, it is according to the slab rate with 20% indexation. However, the holding period is quite high, which is 3 years. For real estate, it is again slab rate and 20% indexation, and the holding period is 2 years. When you see the listed bonds, it is again with the slab rate, but the holding period is lesser, which is 1 year. So if you see, it is quite complex. It is different for different asset classes, and moreover the tenure is also different. The government is looking forward to get this simplified this particular year. With this, we have come to the end of this video. I hope the expectations are matching your expectations too. If yes, please comment down below. Moreover, if you like the content, please hit the like button and subscribe to the channel. Thank you.